In December 2024, Talabat pulled off the biggest tech IPO on the planet, raising $2 billion in Dubai. 15 months later, the stock had lost more than 60% of its value. Here's the strange part. The business never stopped growing. Revenue up 45%. Profitable. Paying dividends. So why did investors run for the exits? And more importantly, was the market right? Or did it just create one of the best opportunities in the Gulf? If you've ever ordered food in the Middle East, you know Talabat. Founded in Kuwait in 2004, it's now the dominant delivery platform across 8 markets: the UAE, Kuwait, Qatar, Bahrain, Egypt, Oman, Jordan, and Iraq. In the UAE alone, it holds roughly 45% market share, with over 15,000 restaurant partners. But this isn't just a food delivery story anymore, and that's exactly why investors should be paying attention. Talabat's real business model is an ecosystem. Food delivery gets you in the door, but T-Mart, its own network of dark stores, delivers groceries in 20 minutes. And by late 2025, grocery had grown to about 15% of everything sold on the platform. Then there's Talabat Pro, its subscription program. Subscribers tripled in 2025 to roughly a quarter of the entire customer base. Why does that matter? Subscribers order more often, churn less, and are brutally expensive for competitors to steal. Add an advertising business selling visibility to restaurants. And Talabat earns money 3 different ways on the same order. That's the moat. So what went wrong? One word: Kita. Kita is the international arm of Meituan, the Chinese giant that handles over 100 million food orders a day. In Saudi Arabia, Kita became the 3rd largest delivery platform within 4 months of launching. Then, in late 2025, it stormed into Qatar, Kuwait, and Dubai. Talabat's home turf. Its weapon? Subsidies. Free delivery, aggressive discounts, and a war chest that can absorb losses for years. Now look at Talabat's latest numbers with that in mind. First quarter of 2026, order volume up 18%. Revenue up 22% to about $1.05 billion. Free cash flow of $104 million, still genuinely profitable. Adjusted earnings of $130 million. But net income? Down 29%. Margins compressed from 14% to around 8%, as Talabat spent heavily to defend its territory. And when management guided 2026 profit to between $280 and $310 million, below what many analysts expected, the stock cratered to an all-time low of 63 Firos in March. But then something interesting happened. The company started fighting back with its own money. The bull case. In May 2026, Talabat launched a buyback of up to 10% of all its shares, with management publicly saying the market price doesn't reflect the platform's strength. It pays out roughly 90% of profits as dividends, about $421 million for 2025, a yield near 5.4% at today's price. It sits on a net cash pile of over 2 billion dirhams with almost no debt. And history says subsidy wars end. Regulators in Saudi Arabia and the UAE are already cracking down on below-cost pricing, which protects the profitable incumbent. The bear case. Meituan has effectively unlimited patience and world-class logistics. This could be a years-long war, not a skirmish. Margins may never return to 2025 levels. Delivery Hero still owns about 80% of the company, meaning low free float, and any future sell-down could flood the market. And Gulf consumer spending is exposed to oil prices and regional instability. So, is it cheap? On trailing earnings, Talabat trades around 10 times profit, remarkably low for a market leader growing revenue double digits. But on forward earnings, after the margin hit, it's closer to 15 times. For comparison, DoorDash and Delivery Hero have spent most of their public lives losing money, or barely breaking even. Talabat is profitable, cash generative, and paying you to wait. Analysts' average target sits around 1 dirham 35, with 12 buy ratings and 0 sells. The thing to watch? Whether Kita's market share gains stall, and whether margins stabilize in the second half of 2026. Best case, the subsidy war fades, regulators keep tightening, pro subscribers keep compounding, and today's price looks like the bottom of a panic. Base case: growth stays healthy, margins stay squeezed through 2026, and the dividend pays you while the war plays out. Biggest risk: Meituan treats the Gulf like it treated China, and simply never stops spending. This isn't financial advice. It's a map of the battlefield. The market has priced Talabat like it's losing the war. The numbers say it's still winning most battles. So here's my question. Would you buy Talabat at today's price, or wait to see Kita's next move? Drop your take in the comments. The best argument gets pinned.